So wait, billionaires avoid a lot of taxes.
Yeah, they don't pay any tax.
And that's something that you and I could do too?
No.
Hey, it's 5 Minute Finance. I'm Matt Robison, and that is Mike Morton, our certified financial planner, who is here to lighten your load, not optimize the ever-living you-know-what out of you. Just get you an awesome solution and get you on your way so you can live your life. We are talking today about whether you could maybe hack your way to the same tricks that billionaires use to avoid paying taxes. And I don't want to totally bum people out at the start, but you're saying there's a chance.
I'm saying there's a chance. No,
but people will understand in this how billionaires do avoid paying their taxes and why perhaps the rest of us can't quite use the same tricks.
I think that's the important thing here, because you hear like billionaires don't pay any tax. And how do they do it? Like, I don't understand. They're making like zillions of dollars. They have $1 billion. They're making, 10 million a year, 100 million a year, like how do they not pay tax? And then of course, like, is that something I can do? So let's break, today we want to break down like how this works. And then, potentially what strategies may or may not apply to the everyday multimillionaire.
Very good. Very good. And as if that understanding were not enough, hang on, as always, for our listener question. Got a really interesting one today about what to do if you've got company stock. We've got a fascinating one thing that revolves around one of the wealthiest men on earth, and a surprising fact about him. And, of course, a really interesting distinction in our worth knowing discussion about being in the top 1%. So there's a lot jam-packed into the remainder of this episode. But should we talk billionaires?
Let's talk billionaires.
All right, here we go. All right, set us up here. Billionaires, they don't pay taxes. This sounds like bullshit. What the hell?
Yeah, exactly. So let's break down where taxes come from. When we say the word taxes, what we're really saying in this one is income taxes. Okay. So do billionaires pay income taxes? And recall that, when you make an income, you got a W-2 salary, you've got a job, you're self-employed where you've got income. That is all income. And the government's really good at taxing income. Like, they have a really long code about how it works and what you owe, and they plug loopholes all the time. And the income tax code is pretty robust. Like, if you make income via W-2 or self-employed salary, you're going to get taxed on that.
And the trick here is that billionaires don't necessarily make their money the way the rest of us do, right?
Billionaires have already made their money. That's why they're a billionaire. And so now you're like, well, now you're a billionaire. Why aren't you taxed? Well, because they have no income. Remember, income is a salary from your job. And so maybe they're the CEO of a massive company, and you know what CEOs can pay themselves? Whatever they want. So they could take zero income, and that's typically what they do. They're paid entirely in stock or options, or they just own all the stock already. That's why they're a billionaire. So they don't have any income, and they're not paying any income taxes. Now, I'll also say this. Here's the stat people throw around. Okay, Warren Buffett, he paid 0.1%. I have to pay like 24%. He paid 0.1%. And Michael Bloomberg paid 1.3%. How come they're paying such a small rate? They're hardly paying any tax at all. Well, the reason that number, one, I just told you they hardly have any salary. The other reason is, how it's calculated? It's the increase in their net worth, the increase in their stock versus what tax they paid. That's how those numbers are calculated.
Right.
It's not like, hey, they made 100,000 and they paid 80 grand in tax. So that's 80%. No, they paid 80 grand in tax and their net worth went up by 10 million. So it was 0.1%.
The world is awesome. And there's also an aspect of this that you get all kinds of helping hands, let's say, from the financial system, if you are in a position where you have lots of investable resources at your disposal.
Yeah, absolutely. Sure. I mean, that's the same with anything, like more money, more power, more network and stuff like that. But I think the big takeaway here is understanding there is literally a difference between someone that's got let's just call it cente millionaires. You've got over 100 million or 200 million up through billionaires, and what somebody that even has 20 million or 30 million. There's a difference between someone that's got 30 million and then someone's got 300 million and what you have access and being able to do.
But I mean specifically and literally, if you have that amount of money at your disposal, financial institutions will let you get away with a pathway for you to live a luxe lifestyle without having to have an income and you can, there's like a trick to this.
Well, okay. Yeah. So let's get into it. It's called the buy, borrow, die strategy. But let me define it. And then Matt, I want to answer some questions back and forth because there's some stuff that people don't quite understand about how this works. So buy, borrow, die. So what you do is, or it should be borrow and then buy, then die. Okay. So you have, I've got $300 million. I got $1 billion and I want to buy a yacht. I want to buy this $20 million mansion. Okay. Well, how am I going to get my $20 million to buy this mansion? I don't really want to sell my stock. Well, I don't have an income. I don't have 20 million of income because I don't have, I'm CEO of the company. I don't need the income. I give it to all my employees. So I don't want to pay tax. I don't want to pay 80% tax rate on my income. So don't bother paying me. So I don't have 20 million. So what I do is I'm going to borrow the 20 million. Now I'm worth $1 billion. Okay. So 20 million is like, it's changing the cushion. Okay. So I go down to my private bank and I was like, I need to borrow 20 million. I got $1 billion. It's worth $1 billion in stock. And they're like, no problem. We know you're worth $1 billion. Here's 20 million. You could pay us like 3% interest, because we know you're good for it. So you're definitely paying us back. So like we give you super low rates and here's your 20 million bucks. Then I go buy my house. So I didn't pay any tax on that because I don't have an income. I didn't sell anything. I just borrowed the money at 3%. Now I do have to make payments, but luckily my stock is spitting off interest and dividends, so I can make the payments. No problem. Because it's chump change for me. Okay. And I can go buy my yacht or my mega mansion. All right. Now, eventually I'm going to die and the whole thing gets settled, but the estate gets settled. I'm going to avoid that conversation. It's going to be another podcast about estate planning and avoiding estate tax, capital gains tax, inheritance tax, etc. But that's the die part is like everything gets wiped out. No one ever pays the tax. I mean, you still got to pay back the money you borrowed. And that's the important thing. So let's get to that question. Okay, so that's how it works for billionaires. You buy, borrow, and die, and no one ever pays the tax.
Yeah, and just for people who are looking for a fun time, for a good time, search in your podcast feed because we actually did a whole episode on this years ago about whether regular mortals could get away with this whole you borrow. And that was sort of the sneaky message here. It's like, well, if you've got $1 billion, banks are happy to do this. And for you, it's like a perpetual motion machine because you're making a higher interest essentially on your assets than you're paying to borrow the money. So you're actually making money if you're a billionaire by borrowing and using that for the spending in your life. The rest of us can't quite get away with that.
But here's why you can't get away with it. It's not only the engine of like your gains, it's literally the amount of money they're borrowing versus what they are worth. Matt, do you think you could go in the bank and borrow $20 to buy groceries?
Probably.
Do you think you'd ever have to pay back that $20? Do you think you could go the rest of your life without paying back the 20? Sort of compounding interest. All right, maybe it goes to $80 and you die and your estate has to pay off $80.
I mean, eventually I'd get messages and phone calls and credit ratings and there would be consequences.
For borrowing $20? No chance. The point is, that's the kind of exchange rates we're talking about if you're a billionaire. That's what they're borrowing. It just isn't that much money. And so let's take it back. Hey, even someone that's worth 30 million. All right, could I borrow $1 million? Of course, you can. So you're worth 30 million, you got 30 million of stock. You can go into the bank, they'll give you really good rates and they'll let you borrow $1 million because they know you're going to pay it back also. You just can't go the next 40 years. That's 3%. That's going to compound if you want to borrow another million so now we're up to 2 or 3 million on your 30 million. That's 10% of your net worth. Okay. And you start borrowing that and letting that compound, it's just not going to play out. The numbers don't work.
The other thing that I've never understood in this whole equation, maybe you could just tell me, is like, so go back to your first example. I'm a billionaire. I like this already. I'm a billionaire. I'm borrowing 20 million. I'm paying 3%. What is the source of my, like, I have to pay off the 3% every year. Like, what is the source of that? Am I just borrowing more from elsewhere?
Yeah, you just borrow.
And you just do it perpetually. And then there's the die part of this, which I have to say, of the borrow and buy, I'd say the die is my least favorite part of it.
Yeah. Yeah. Well, unless it's your uncle. I mean, if it's you, it's not so great, but
yes,
if it's your uncle following this strategy, it might be, about time.
I mean,
but that's what it is. I think to your question, it's like, yeah, you just keep borrowing. And then of course you see people selling their homes too. Like, oh, Taylor Swift, sold this mega mansion for 30 million. So like, you're not always just like buying and buying and buying. Sometimes you're selling some of the stuff, or like your business venture. It's like, okay, Larry Ellison is going to buy Paramount for, $40 billion. Well, he's just going to borrow the money, because he's worth $215 billion. And, the stockholders and business exchanges and all kinds of stuff, like you get the money back,
Yeah. And I think that's really the key of all of this, is that there are ways, and it's not that these people never pay taxes in any form. There are real estate taxes. There are, if you are going to liquidate some of your investment holdings to free up some cash, you're going to pay some capital gains. But there are a million other tax avoidance strategies here. The point being that at the end of the day, for this basic machinery of like paying for major things in your life, you don't have to do it because you have the assets to borrow.
Yeah, you can buy. So here's the key. Salaries are for suckers. When you have a salary and that's your income, you're paying income tax. And I told you the income tax, they're pretty good at like collecting their money. You know where they're not good at collecting money? Wealth tax, estate tax, capital gains tax, business tax. I want to start my business. I can start it in Ireland and pay, 10 cents or 15 cents. Plus we can do all kinds of other business stuff. We can make trusts and estate planning and gift tons of things, or create these entity structures that avoid tons of tax. All right. So income tax is where the government's really good. And that's why billionaires don't pay themselves income, because they can't get out of not paying it, the income tax.
Well, you said a bunch of important things in there. You're talking about estate and, tax efficiencies. And that's really, I think, where we want to get to with this, because all of this is kind of intellectually interesting and a little infuriating and kind of fun to know for people. But I think your main point, unless I'm missing something, is that there are lessons that the rest of us can apply here to our own savings, investment, tax avoidance, et cetera.
Absolutely. Yeah. I mean, it's the stuff we talk about on the show all the time. Are there things you can do to compound your wealth, to avoid, paying tax, pay just the appropriate amount of tax? Absolutely. So can you do the buy, borrow, die strategy? Probably not. Okay. Because you just can't compound, absorb that compounding borrowing. All right. But let's talk about some of the strategies we talk about on the show all the time. Can you create your own dynasty and dynasty wealth? Yeah. We had the episode on the 529. It's like a great poor man's dynasty, right? Like you can put money in there, it compounds, tax free. You can use it for your kids' education, grandkids' education, and keep it going. Tax efficient. So we talked about, what else do billionaires do? They never sell their stock. All right. You don't want to take the capital gains hit. Why sell the stock if I can borrow? So same thing in our own stock portfolios, Matt. You want to have tax efficient, hold the right kind of funds, hold the ETFs in your taxable account. You want to avoid paying capital gains tax. You want to gift it onto not gift it, you'd like to die with it. So you avoid paying capital gains at all. So there's a number of strategies that compound over time.
And what it all kind of boils down to is just sort of the mindset of, okay, you can't borrow and kind of like set up that machine. You certainly can't do it the billionaire style of you actually end up ahead because you earn a higher percentage than you're paying out to borrow. But you can try to minimize your tax drag. That's the piece of this that you can do.
Yeah, absolutely. Absolutely. And so the big thing here, and this is the 5-minute task for today, is understanding the difference between your income and your own growth engine of your net worth or your wealth. All right. And this is really important because this is kind of how the billionaires do it. It's like, hey, I grew, I started this company. It's worth $1 billion. I own most of it. And now that billion is how I live my life.
Right.
I no longer live off the salary. All right. So let's play it into our own lives. When we started, most people listening, get your first job. I have no net worth. I'm making, $15,000 a year at a part-time job. And then I graduate from college or I get a full-time job making 40 grand a year, 50, 70 grand a year, whatever. You have nothing saved yet. And so that's literally what you're living off of, my 50 grand a year. And I'm chipping away at the savings. I start saving a little bit, but that's totally, everything's on the income side, right? Even the first 10 years, everything's still on the income side, slowly growing. But as you get in your 50s, 60s, now your wealth, the 401ks, your taxable brokerage account, maybe you got some stock equity compensation that vested, So now you got 2 million like saved over there. That 2 million is compounding now almost faster than your income. Okay? So you're reaching that escape velocity, that retirement, right? Where now it's like, oh, I don't need the income. My wealth is generating and compounding the income, what I need for the future. That's what retirement's all about. So I would do that calculation, say like, okay, here's my household income and here's my net worth minus what I'm saving, and check out that engine and understand that engine is going to continue to grow faster than your income.
And the one other dot I was hoping you'd connect, and then we can get out of here, is what about the recent episode that we did of side hustles, other sources of income, passive income? It sounds like you're suggesting that sort of the lesson, the mindset you can take from the billionaire experience is, how do you think about drawing more of your assets, more of your net worth through more tax efficient means, like less salary, more like, well, this is a real estate holding, and I can hold on to it. It's going to have a different tax treatment. This is a different type of investment vehicle. Perhaps it's like my own VC, and I'm going to have gains in this that are not going to be subject to capital gains, or I can hold them. How do you shift your orientation as you kind of like build your way up the wealth ladder so that you are treated more like a billionaire and less like the rest of us?
Yeah, I would definitely take that into consideration. So those side hustle opportunities, try to avoid the straight up income where you're trading your time for dollars and eventually you decide not to do that. That's totally cut off. So the simple one again is real estate. I'm going to trade some of my time for an investment. Like maybe I get some passive income, but I'm plowing a lot of it back in the business. It's actually under a business structure where I have this rental property or commercial property. So I'm spending, 100 hours to research and find the right thing and manage it, but it's adding to the net asset side, not the income side. And it's growing wealth through there. And anything that avoids the income tax is going to be beneficial when it comes to taxes.
Man, that's so zen of you. It's like, to make more money, avoid income. There is no spoon. All right, anything else?
That's it, man. There is no spoon.
There's no spoon. All right, let's get to our listener question. And this week, I guess it's somewhat related to the main theme here of other kinds of assets that aren't strictly straight up income. The question is, if I have a large amount of company stock or RSUs, how do I know when it makes sense to diversify versus hold? If you would answer that and remind us all what RSUs stand for.
RSUs are restricted stock units. It is a bonus paid in stock. So it's taxed as a straight up cash bonus, the same as a cash bonus is taxed. My general recommendation is to say it again, which I've said in all the podcasts. It's a bonus paid in stock. Matt, if I gave you a $20,000 bonus, would you run out and buy your company stock? Most people say, no, I already work for the company. I already own a bunch of the stock. And so therefore I recommend selling RSUs as they vest and diversifying that. Now, that's exactly this question, however. If I have a large amount of company stock or RSUs, when does it make sense to diversify? Well, let me tell you a story. I have a friend of mine who works for NVIDIA. And this friend reached out to me and said, my stock is now worth $4 million. I'm thinking about, trying to diversify and sell some of it, And I was like, well, that sounds like a good idea. Take some risk off the table, blah, 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 like the normal things we talk about on this podcast. And he nods his head. And a couple months later, I checked in. I was like, hey, did you, have you started executing the plan to try to sell down some of that stuff? He's like, I did a little bit, but not much. I was like, oh, okay. You're taking a lot of risk. He's like, yeah, I know. You're like the fourth or fifth advisor over the last 4 or 5 years I've just reached out to get some, professional help and support. And all of them told me the same thing. They told me at 500,000. They told me at 1 million. They told me at 2 million. They told me at 4 million. And if I had done it at the, 500,000, I'd have 500,000. Now instead I have 4 million.
There you go.
So that's interesting. And so it gets back to this concept of do you want to get rich or you want to stay wealthy? And only you can decide which strategy is more important to you at this moment and for you and for your family.
All right. And if you have a question like this and you're shopping around 4 or 5 different financial advisors, try Mike along the way. You can email him pod@mortonfa.com. Let's get to our one thing.
All right.
This one's just, you're throwing it in because it's on theme, but it's kind of interesting.
Yeah. I find if Warren Buffett is about Warren Buffett. I find him fascinating. He still lives in the same house he bought in 1958. He still lives in the same house, Matt. How long have you lived in one house? What's the longest you've lived in one house?
11 years.
11 years. Yeah, I'm trying to think for myself, the house I grew up in, so it'd be 18 years, So he's living there since 1958. And that's the fascinating thing about Warren Buffett. He's super wealthy, like we're talking about today. But one of the reasons, he's certainly wealthy because he's very smart and worked hard for many years. Absolutely. And maybe gotten lucky too. And he'd claim the same thing. But the biggest thing I find fascinating is that he keeps the expenses low and lets money compound. He would definitely agree with where we started this episode. Don't interrupt compounding. Leave the money there. Just let it keep going. Never sell. Just let it keep going. And he's been investing for 80 years or more. And that's why he's grown to such, having such wealth.
All right, this is a really interesting distinction that you're making here, and I'll let you do it.
Yeah. So what is the top 1%? What is the top 1%?
I would say it's anyone who is just beneath me.
Yeah. That's right. Top 1%.
Define on what
that's aspect. It. Yeah, that's exactly. Looks. So we say top 1% looks. Oh yeah, totally, Matt. You're in the hunt. So top 1% of income versus top 1% of wealth is totally different, right? So when we say bandy about, they're in the top 10%, top 1%, you got to define, obviously, what are we talking about? So the top 1% of earners, you'd have to be making about $700,000 a year to be in that top 1% of, about 600, 700,000 a year to be in the top 1% of earners. Does that surprise you?
It sounds actually high. I would have thought it might have been slightly lower. Just given everything you just explained about how people who are really rich don't make much in terms of income. What you're really talking about there is the high end of professionals who are still drawing a salary. So I guess the number makes kind of sense. All
right. Top 1% by wealth, Matt. Top 1% by wealth is somewhere between 13 to 15 million of net worth. How does that strike you?
Yeah, that feels to me like one of those, it's a skewed average. There's something just under 1,000 billionaires in this country. And it feels to me like they're really bringing that number up, because I would suspect that the number of people with a net worth, well, I don't know, maybe I'm talking myself out of this, because on the other hand, there are a lot of people with small to medium-sized farms, the kinds of holdings that could go into estates where your net worth, the value of that could be 10 million, 15, 20 million.
Yeah, 1 out of 100 people, right? 1%. There's a lot of people that are just sitting on money. And they didn't even get it. They probably didn't get it from earning. That's the point of this episode. They didn't get it necessarily by making, $500,000 a year. Like, it's hard to grow to 15 million just making the salary, because it gets taxed, so high. A lot of those people, I'll bet, inherited money. They're in business, family business, or they're in business in general, compounding, growth, getting a head start when they were young, et cetera, et cetera. Well, there you go. All Top right. 1%.
Well, guess what? I don't fit in either category. So it's all, like
outside looking in.
Yes, exactly. Something to aspire to. All right. Speaking of aspiring, let's aspire to the end of this episode. For Mike, I'm Matt. We'll see you next time.
Thanks, Matt. Thanks for joining us on 5 Minute Finance. If you like what you heard, please subscribe to and rate the podcast. It makes a huge difference for my show. You want more? Find Morton FA on Substack. If you have a comment or question, please email pod@mortonfa.com. Until next time, thanks for tuning in. This recording is for informational purposes only and should not be considered for investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. I cannot guarantee the accuracy or completeness of the data presented here.